Here's what nobody tells you about dividend investing. Harry put $10,000 into dividend stocks. The S&P 500 index back then. By 2023, those dividends alone were paying him $7,400 annually. Not from selling shares, just pure dividend income. That's a 74% yield on his original cost. But here's where it gets crazy. He almost lost everything in 2015 because he didn't know what I'm about to show you. And if you're chasing dividends without understanding this, you're walking into the same trap. See, everyone talks about the Dividend Snowball, this magical compound interest machine that supposedly builds passive income streams forever. The concept is simple. Buy dividend stocks. Reinvest the payments. Watch your income grow exponentially. It sounds bulletproof. But there's a dark side to dividend investing that destroyed thousands of portfolios, including Harry's. Today, I'm revealing 7 specific ETFs that actually work, each with different strategies, each for different stages of your wealth-building journey. But first, let me show you the disaster that almost ended everything. December 2015. Kinder Morgan was the income investor's dream. Pipeline company, stable business model, 6% dividend yield. Harry had $50,000 invested, $3,000 in annual income. Then management made an announcement. 75% dividend cut. The stock crashed from $40 to $15. Harry's income dropped to $750. His principal, devastated. But Kinder Morgan wasn't alone. General Electric, paid dividends since 1892. Never missed through the Great Depression. 2017, cut by 50%. 2018, cut to 1 penny. Royal Dutch Shell, 80 years of steady payments. 2020, 66% cut. First reduction since World War II. AT&T, the supposed widow and orphan stock. 2022, 47% cut after the Warner Media spinoff. See the pattern? These weren't penny stocks. These were blue chips. Safe dividend payers. But here's what changed everything for Harry. I showed him data from Ned Davis Research. 51 years of market history. The results were shocking. Companies that grew their dividends, 10.2% annual returns. Companies with flat dividends, 6.8% returns. Non-dividend stocks, 4.3% returns. Companies that cut dividends, negative 0.9%. Think about that. $10,000 in dividend growers became $1.47 million. $10,000 in dividend cutters became $6,200. The dividend snowball is absolutely real. But only if you pick the right snowballs, the ones that grow, not melt. After months of investment research, I've identified 7 ETFs, each using a different approach, each solving a different problem. Let me show you exactly how they work. Quick disclaimer. This video is for education only, not financial, tax, or legal advice. Investing carries risk, including loss of principal. Always do your own research or consult a licensed advisor. The first ETF, VIG. The biggest mistake in dividend investing? Chasing yield. That's why the first ETF is Vanguard Dividend Appreciation, VIG. $110 billion under management. Rock bottom 0.05% expense ratio. S&P US Dividend Growers Index. Here's what makes it brilliant. It requires 10 consecutive years of dividend increases. No exceptions. And it specifically excludes the highest yielding 25% of stocks. Why exclude high yielders? Because they're often value traps. Current yield, 1.7%. That's pathetic, you might think. But those dividends are growing 6 to 8% annually. Your yield on cost doubles every 9 to 10 years. Start with 1.7% yield today. In 20 years, you're earning 6.8% on your original investment, without touching the principal. Top holdings: Microsoft, 4.6% weight. Apple, 4.1%. Broadcom, 3.8%. Quality companies. Growing dividends. Lower volatility than the S&P 500. Beta of 0.85 means 15% less volatility. perfect for young investors building their investment portfolio. But VIG has strict rules that exclude newer dividend growers. The second ETF, DGRO. Enter iShares. Core Dividend Growth, DGRO. This fund catches rising stars earlier, only requires 5 years of dividend growth, but adds a crucial safety filter: payout ratios under 75%. Why does this matter for financial planning? Companies with lower payout ratios have room to grow dividends, even during recessions. $33 billion under management, 2.2% yield, higher than VIG. Broader diversification with 400-plus holdings. The magic is in the selection process. Morningstar's wide moat focus. Companies with sustainable competitive advantages. The kind Warren Buffett buys. Recent performance? 13% annualized over 3 years. Beating the S&P 500's dividend yield while matching returns. Top sectors: technology, 21%. Healthcare, 19%. Financials, 17%. More growth-oriented than VIG. Better for accumulation phase. But what if you want meaningful income today? The third ETF, SCHD. This is the crown jewel. Schwab U.S. Dividend Equity, SCHD. The perfect balance. $72.6 billion poured in. Why? Because smart money found the sweet spot. 3.7% current yield. 12% dividend growth rate. The Dow Jones U.S. Dividend 100 Index. But here's the genius. First, it screens for 10 years of dividend history, then filters by fundamental strength, return on equity, return on assets, cash flow to debt ratios. Only then picks the 100 highest yielders. Quality first, yield second. Current top holdings tell the story. Broadcom, AVGO, 4.8%. AbbVie, ABBV, 4.5%. Chevron, CVX, 4.3%. Financial advisors love this fund because it works in any market. 2022 bear market, SCHD fell 3%. S&P 500, down 18%. 2023 recovery, SCHD up 15%. Nearly matched the market with less risk. Harry now has 40% of his portfolio here. The backbone of his retirement savings? The fourth ETF, NOBL. But what about true stability? ProShares, S&P 500 Dividend Aristocrats, NOBL. These companies aren't just consistent, they're generational wealth builders. Requirements? 25-plus consecutive years of dividend increases. Not 25 years of payments, 25 years of increases, through .com, through 2008, through COVID. Currently, 68 companies qualify, equal weighted across all. No single stock exceeds 2%. Ultimate diversification. 2.1% yield seems low, but the reliability is unmatched. Standard deviation, 14.2%. S&P 500, 17.7%. 20% less volatile, with comparable returns. Interesting sector mix. Industrials, 24%. Consumer staples, 20%. Healthcare, 15%. Tech, only 4%. Why so little tech? Most tech giants haven't paid dividends for 25 years. This is your defensive anchor, the fund that pays through anything. Insider activity confirms it. Congressional members bought heavily in Q1 2025. They know something. The fifth ETF, DIVO Now for the innovation. Amplify CWP Enhanced Dividend Income, DIVO. This isn't passive indexing, it's active money management. 25 carefully selected stocks, blue chips only. Then they do something brilliant. Covered call options on 30 to 40% of holdings. Selling calls generates extra income without sacrificing all upside. Results? 4.6% yield. Paid monthly. Tax efficient with 65% qualified dividends. 5-year returns, 12.8% annually. Beta, 0.70. Translation, market-like returns with 30% less volatility. Current top positions. Microsoft, 5.2% Apple, 5.0% United Health, 4.8% JP Morgan, 4.5% quality names, with option income on top. The 0.55% expense ratio is higher, but performance justifies it since inception. NAV appreciation, 57%, plus that monthly income, perfect for pre-retirees wanting passive income streams. The sixth ETF, JEPI. But what if you need maximum income now? JP Morgan Equity Premium Income, JEPI, the income monster. 7 to 8% annual yield, paid monthly. $36 billion under management. How is this possible? Equity-linked notes, ELNs. Synthetic covered calls on the S&P 500, capturing option premium efficiently. The strategy caps upside at roughly 10 to 12% annually, but delivers that income rain or shine. 2024 performance proves it. S&P 500 up 26%, JEPI up 9%, but paid 8% in dividends. Total return, 17%. Not bad for an income fund. Major warning though, only 15 to 20% qualified dividends. Rest taxed as ordinary income. In the 24% bracket, your 8% yield becomes 6% after taxes. Must hold an IRA or 401k. Never taxable accounts. Perfect for retirees needing immediate income. Living expenses covered without selling shares. The seventh ETF, SPYI. The game changer arrived in 2022. NEOS S&P 500 High Income, SPYI. This solved JEPI's tax problem. 12% distribution yield. Yes, 12%. Monthly payments. But here's the breakthrough. 94% classified as return of capital. Not currently taxable. Just reduces your cost basis. It's tax-deferred income in a taxable account. $4.9 billion flooded in. Smart money noticed. The strategy? SPX index options with 60/40 tax treatment. More sophisticated than JEPI. And unlike JEPI, they don't fully cover, allowing more upside participation. 2024 results stunned everyone. 19% total return, while distributing 12%. The math shouldn't work, but it does. For taxable accounts, SPYI beats everything. That tax deferral is worth thousands. But remember Harry's disaster? Here's your protection checklist. Payout ratio above 80%, red flag for non-REITs, debt to EBITDA over 4x, danger zone, interest coverage below 3x, dividend at risk, dividend frozen 2 quarters, cut likely coming, yield suddenly spikes above 8%, market pricing in problems, recent insider selling? Management knows something. These signals saved Harry from disaster in Intel, INTC. Cut 66% in 2023 Walgreens, WBA. Cut 48% in 2024 Boeing, BA. Suspended entirely, investment research prevents catastrophe. Check these metrics quarterly. No exceptions. Your age-based asset allocation blueprint, 20s, 30s. Building phase, 40% VIG. Maximum growth, 30% DGRO. Broader opportunity, 30% SCHD. Income foundation, 40s, 50s. Acceleration phase, 30% SCHD. Core holding, 25%. VIG. Continued growth, 25%. NOBL. Stability, 20%. DEVO. Enhanced income. Pre-retirement. Transition phase, 30%. SCHD. Balanced core, 25%. DEVO. Monthly income, 20%. NOBL. Safety, 15%. JEPI. Income boost, 10% VIG. Growth element. Retirement. Income phase, 30%. JEPI or SPYI. Maximum income, 25%. SCHD. Growing income, 20%. DEVO. Enhanced yield, 15%. NOBL. Stability, 10%. Cash, chalk, bonds. Emergency buffer. Critical, tax location optimization. Roth IRA, JEPI, REITs. Highest growth potential. Traditional. IRA, DEVO, high yield funds. Taxable, SPYI, SCHD, VIG, qualified dividend payers. This structure minimizes taxes while maximizing compound growth. The evidence is overwhelming. $10,000 invested in dividend growers. Worth $3.2 million today. Same amount in non-dividend stocks. Worth $470,000. The difference? Dividend reinvestment plus growth. Real-world example. Harry rebuilt after Kinder Morgan. Started with $30,000 in 2016. Split across these 7 ETFs. Today, portfolio value, $78,000. Annual dividend income, $4,200. Growing 8% yearly. By 2030, projected income, $6,200. Without adding a penny, that's the snowball effect. Each dividend buys more shares. More shares generate more dividends. The cycle accelerates. The dividend snowball isn't fantasy, it's mathematics. But it requires 3 things: quality companies that grow dividends, reinvestment discipline, patience to compound. These 7 ETFs provide the framework. Your financial goals determine the mix. Young? Emphasize VIG and DGRO. Middle-aged? Balance with SCHD and NOBL. Near retirement? Add DEVO and JEPI. Need income now? SPYI changes everything. The 10% yielders that cut dividends? They're lottery tickets, not investments. The 2 to 4% yielders growing 8 to 10% annually? They're wealth builders. Harry learned this the hard way. Lost $35,000 chasing yield. Rebuilt with quality. Now his dividend income exceeds his working years, growing faster than inflation. Protected from market crashes, the snowball rolls on. This time, built to last. Start with these 7. Let compound interest do the rest. Your future self will thank you.